Chapter 9, Master Budgeting. Learning Objective 1 is to understand why organizations budget and the processes they use to create budgets. So what we'll talk about here is what budgets are and how they're created. A budget is a detailed plan for acquiring, using financial and other resources over a specified forthcoming time period. In other words, the budget is a plan for the coming year or a coming period of time that is in numbers. So rather than simply writing out in words what's going to happen, you actually create a plan, a financial plan for what's going to happen to your company. And that financial plan will explain how much you're going to make, how much it's going to cost to make it, what you expect all your expenses to be, all your cash flows, what you expect your profitability to be, and what your balance sheet is going to look like at the end of the period. And it may be for several periods. It could be for up to 5 years, let's say. So the nice thing about the budget is it allows you to work through all the details of your company's operations in a realistic way that you're going to meet your goals during the period. So the act of preparing a budget is called budgeting. And use of budgets to control an organization's activities, which is what every company does, is called budgetary control. Let me talk a little bit more about planning and control. Planning and control are kind of can be used as a way of just understanding management from start to beginning. Planning is developing your objectives and preparing budgets to achieve those objectives. It's really the entire set of objectives, budgets, and policies that you use to run your company. That's really what planning is. Planning is developing what you think is going to happen over the coming period, how people are going to do things. And the whole thing about a plan is that you've put together all of the details so that if certain things happen the way they're supposed to, then you're going to have your plan, your outcomes are going to happen the way that you plan them to happen. So for example, if you plan for certain sales and certain expenses, if that's really what happens, then you're going to have the profitability that you planned. So planning is a very comprehensive process. It's a lot of work, but it's really key to developing an approach towards managing your company. And what control is more important. Most people understand what planning is. A lot of people don't understand what control is. Control is checking to see how closely the company is following its plan. So steps taken by management to increase the likelihood that the objectives set down while planning are attained. All parts of the organization are working together toward that goal. In other words, you have a budget, and the process of control is determining that the budget is being followed, or when it's not being followed, why things are different from the budget. And so control gives you a lot of information about what's going on during the period and insights into what things when they might be going wrong. And it gives you an opportunity to steer them right or to change your plan around so that ultimately you'll be able to meet the goals that you want to meet. So planning and control kind of go together, in that planning is about deciding where you're going to go and how you're going to get there. And control is making sure that along the way you actually get there. A good metaphor would be, let's say you're going on a trip, as I was saying, and you have a certain destination, you want to drive to Grand Canyon. Planning would be putting together all of your maps. Today you do it in Google Maps or whatever. But putting together your maps and determining how you're going to drive, where you're going to be certain days, and setting up all kinds of different details to make sure that you're going to be able to get to your destination on time. What control would be is when you start driving, making sure you're on the right road. It would be, if you have a schedule, making sure that you're following the schedule. If you fall behind in your schedule, thinking about how you're going to catch up or what you're going to do if you don't catch up. It would also mean, what if you make a wrong turn? It would be identifying when you've made a wrong turn and trying to figure out how you're going to reach your destination even though you've taken a wrong turn. So planning and control are really critical to quality management and provides you with a very powerful tool for running any company or an organization. So the advantages of budgeting are that they define goals and objectives, they think about and plan for the future, their means of allocating resources, they tell you where you should spend your money and where not, and coordinate activities and communicate plans. Once you have a budget, then you know what's going to happen during the coming period. Everybody is on the same page, so to speak. That's the really wonderful thing about a budget, is it puts everybody on the same page. Everybody knows what they're supposed to do and what's supposed to happen, and it forces everybody to work together to reach those goals. And responsibility accounting is really just an idea. And it's the idea that managers are responsible for the things that they actually have control over. So it sounds pretty simple, but basically what it means is that different people have responsibility for different things. And in order to have responsibility for something, by definition, that means you have some control over it. So you can, you have some control over the situation, and you have the ability to make decisions that will affect outcomes that you're going to be responsible for. And then you choose the budget period. An operating budget is usually for the next year, and it could be the next 12 months or the next year. A continuous budget would be the next 12 months, and every month, next month, it's going to roll forward for another month. But you could also have long-term budgets for 5 years, let's say. It's always a good idea to do both. And self-imposed or coordinated budgets are where, participative budgets are where a lot of different people work together to create a budget. And this is what's done in most companies. In most companies, what would happen is you have these big meetings, and everybody gets together, and they talk about what they're able to do and what's realistic and what's not realistic. And managers of the company might say, hey, we're expecting you to make this much sales. And then people who are in the sales department say, yeah, but we can't, that's not realistic for next year. We need to adjust the sales. And they might even say, we can get more sales than that, budget us for a little more. So the idea of participative budgeting is to get everybody together to talk about what the plan is and to set up a plan that's realistic from all different angles. So one of the nice things about doing this is it creates a sense of teamwork where a lot of people together can make judgments and hopefully come up with a better product than if a few people worked on their own. In general, people who are on the front lines, people who are middle managers, have a better idea what's going on the ground than upper level managers. So the more people who are involved in making estimates and assumptions, the more likely that you're going to get an accurate estimate and assumption. And when people have some say, they say, management people at least say, that when people have some input into the budget, they feel more motivated than if the budget is just given to them as a piece of paper and said, here, do this, you got to make this much sales this year. Rather, people feel a little more motivated when they have some input into the process. And without that, managers can claim that, hey, you made this up without even asking me anything, and it's completely unrealistic, and what am I supposed to do with this? I was never able to make this. You should have asked me first, kind of thing. So the other kind is you have also what's called a self-imposed budget. And what would happen here is where the middle level managers, I don't like the term lower level, I don't know. I like the term middle level, but here they use the term lower level, so I'll use their term. Lower level managers, to me, it doesn't make sense to have lower level managers because that means there's people still below them, right? So lower level managers are kind of, all right, I guess there's even lower level people who are below the lower level managers, and it gets very confusing. I like to say middle managers. Anyway, most companies issue broad guidelines in terms of overall profits and sales, and lower level managers are directed to prepare budgets that are going to meet those targets. And what happens is with a self-imposed budget, everybody works together, and the budget kind of goes up and down, management. I think a self-imposed budget, it may go up and down. There will be discussions. Some managers may say, well, they might pad their budget a little bit just in case, and then other people can come in and say, well, you can't take that padding out. They call it your budgetary slack. But in general, when we're talking about self-imposed budgets, it's a cooperative process, and it's a very powerful process where people can work together. And there are a lot of human factors involved in the budgeting process. People really need to be able to work together and have open conversations and share what their honest judgments. I'm involved in budgeting for an organization, and we have these huge meetings, and they sometimes get quite contentious because people want to make sure that the budget is realistic, and they often have legitimate disagreements about how things should be done. And those need to be talked out. It's a very difficult thing to do. Within management operations, it might be the most challenging thing for a company to go through for a year, each year is the budgeting process. So top management must be enthusiastic and committed. It must not use the budget to pressure employees or blame them. You must meet this budget or else you're fired. And budget targets should be achievable. There's talk about a stretch budget but these are really stretch goals, okay? Managers can set stretch goals, very aggressive goals, but the budget should not be based on stretch goals because oftentimes what we're trying to do is set the objective way up here and hope that people are going to go crazy to meet them, right? But in reality, a lot of times they don't meet them. So when we're budgeting, we want very achievable goals and targets and not stretch targets that are not realistic. This is a kind of an overview of the budget process. I'll take you through this step by step, one budget at a time during this video. What I did, and these are in the notes, is I created kind of a summary of all of these different steps that you can see right here and what they involve. The master budget, at least the way the book puts it, sometimes these things can be combined, consists of 10 different pieces. So the first piece, you always start with your sales budget, and you need to make certain assumptions. What are the budgeted unit sales? What's the budgeted selling price per unit? And what percentage of receivables will be collected in the current and subsequent period? In other words, how quickly you're going to collect the money. What the sales budget will tell you is how much sales revenue you're going to earn and how much cash you'll collect from your customers and when. The production budget is what you need to assume how percentage of next period's unit sales needs to be maintained in ending finished inventory. And then what it's going to tell you afterwards is how many units you're going to produce. Direct materials budget, one, you need to go in knowing how many units of raw material are needed to make 1 unit of finished goods. What's the budgeted cost for 1 unit of raw material? 3, what percentage of next period's production needs should be maintained in ending raw materials inventory? And 4, what percentage of raw material purchases will be paid in the current and subsequent period? And you put that into the schedule called the direct materials budget, and you'll get how much raw materials you're going to need to purchase and how much cash you're going to pay your suppliers for it and when. Direct labor budget, in order to prepare that, you're going to need to know how many direct labor hours are required per unit of finished goods and what's the budgeted direct labor wage rate per hour. And the output will be how much cash will we pay to our direct labor. It'll also be the cost of direct labor. Manufacturing overhead, budgeted variable overhead cost per unit, total budgeted fixed overhead for the whole period, and budgeted depreciation expense. You're going to need that information. And then in order to, what that will tell you is how much cash you're going to need to pay for manufacturing overhead. It's also going to tell you what your overhead cost per unit and your total expected overhead is going to be. Ending finished goods budget will tell you how much finished goods you will have at the end of the period and how much it's going to cost. selling and administrative budget, you're going to have what's the budgeted variable S&A expense per unit, what's the total budgeted fixed S&A expense for the period, and what's budgeted depreciation on non-factory assets per period. And then once you put that in, you'll have how much selling administrative expense you're going to incur and how much cash you're going to pay related to these different expenses. The cash budget, a lot of these other budgets come together with a cash budget, the income statement, and the balance sheet. Because what 1 through 7 do is they kind of measure all the different things that are going to go on with the company. The cash budget pulls it all together in terms of how it's going to impact cash. So what's the budgeted minimum cash balance? What are estimated expenditures for non-current asset purchases and dividends? And what's the estimated interest rate on borrowed funds? So you're going to need to have that information in order to prepare your cash budget. And then the cash budget is going to give you a critical piece of information. Do you need to borrow money during the period to repay lenders? Are you going to need to pay interest and that type of information? Because your cash budget might show that you're running out of money. Then we take all of this, and with it we can prepare a budgeted income statement and a budgeted balance sheet. So the income statement will measure how much manufacturing costs we're going to incur. Direct materials is going to come from the direct materials budget. Direct labor will come from the direct labor budget. Overhead is going to come from the overhead budget. And the total cost that's going to be transferred from finished goods to cost of goods sold, and how much net operating income we will earn. Budgeted balance sheet, what will our balance sheet look like at the end of the budget period? That's really key. So this is sort of a measure of the master budget and the different things that need to happen in order to go through the budgeting process. It's a long process, and it's a lot of work for companies to do. I'll tell you that the way the book describes this is one way. This can actually be done. I've seen this done with 30, 40 different budgets, because if you have different subsidiaries, each subsidiary may have its own budget. I've also seen organizations that will try to put the entire thing on one page. That's more likely in a service organization where you would sort of have a master budget page that would summarize all of this information in one piece. And the book points out that Microsoft Excel is a really great tool for doing this. And what you could do is create a page for your assumptions, or a place where you keep all your assumptions. You could change the assumptions, and then you could fool around and see what happens. Because what you want to do, it's kind of like what you're doing in GoVenture, where you plug in different assumptions. There's a what-if function there too, and you can see what happens. What if I raise my sales? What if I sell another 100 units? How's that going to impact my profitability? These types of things. Learning objective 2 is to prepare a sales budget, including a schedule of expected cash collection. And before we can start, we need some basic information here. The company is Hampton Freeze. Again, this is all from the textbook. There's nothing. If you're wondering what's going on, you can refer to the textbook, and the textbook has the same example. They probably explain it better than I do, but if you like videos, here I am. Anyway, so here's the company's balance sheet at the beginning of the year. December 31st, 2016 obviously would be the end of 2016 or the beginning of 2017, because the end of December 31st, 2016, it's midnight, the clock strikes, so that's the very beginning of 2017. That's the beginning of the year that we're budgeting. And we have a whole bunch of assumptions here that we need to make. And they're all listed for you. And again, I took these from the book. I made a few slight modifications in how I explain this, just to make things a little more clear. So we've been through 10 budgets right here. And these are the assumptions that are relevant to the different budgets. Not every budget needs assumptions, but these are what they are. And again, when you do this in the real world, every company is different. So for the sales budget, we have budgeted sales in cases here. So each quarter, sales, we would sell 10,000 cases in the first quarter, 30,000 in the second, 40,000 in the third, and 20,000 in the fourth. The selling price per case is $20. 70% of those sales are collected in the quarter of the sale, and 30% of the sales are collected in the quarter after the sale. And what I'm going to do is there are more assumptions here. I'll go through these as they're relevant, to the different budgets because I don't want to overwhelm you with information. But this is the information that we're going to need for the sales budget. So we go to the sales budget template, which is what I'm going to fill out now. And again, I wrote the assumptions here at the way top. So we would have this. And the thing for each budget is to just note the basic formulas that you're going to use to do the calculations. I have notes here. There's a lot of notes in this chapter. There's a lot of material in this chapter. Anyway, so what we're going to start off with is we'll start with the budget. We need to forecast how many units we're going to sell, and then we're going to need to forecast how much money we're going to collect. So we're going to do this one quarter at a time. The budgeted unit sales by cases is given to us up here. It's 10,000 in the first quarter, 30,000 in the second quarter, 40,000 in the third quarter, and 20,000 in the fourth quarter, because that's the assumptions that the companies are making. And that's really where you start. You start with how many units do I think I can sell? That is the most difficult thing. And that everything is going to be based on that. The next thing is going to be selling price per case, which in this case is, get it? In this case, got it? No. I thought that was good. In this case is $20. And then total sales is $200,000 in quarter one, $600,000 in quarter two, $800,000 in quarter three, $400,000 in fourth quarter, and for the year it would be $100,000 times 20 or $2 million. What you might want to do is add these up just to make sure that they add up to $2 million. A cool Excel trick is if you just highlight them, then in the bottom of the screen here it'll tell you how many, the average, and the sum. So you can just check your work there and make sure. It's an interesting thing, right? This here adds across to get the total year. For the selling price per case is $20. It doesn't add across, and then the total does add across. Because obviously you wouldn't add the selling price for each quarter together to get for the year. You would only add together the number of units. Now, the next thing to do is a schedule of expected cash collections. And so we'd start off with beginning accounts receivable, and we're going to see how quickly we collect everything. We're going to collect the accounts receivable from last. The rule is that we collect 70% of the sales this quarter and 30% next quarter. Now, is it always exactly that? No. But experience shows us it's about 70-30. 70 in that quarter, 30% in the next. And we started off with receivables of 90,000. And since that's probably the 30% from quarter four of last year. So for sure we're going to collect that. Then I got my first quarter sales. And that would be total sales. I'm going to collect 70% in the first quarter. And then I'm going to collect 30% in the next quarter. So this 200,000, 140 of it I'm going to collect in this quarter, and 60,000 I'm going to collect in the second quarter. Second quarter sales are 600,000, and again I'm going to collect 70,000 of that. Oh, you know what? I'm in the wrong quarter here. Why didn't you say something? There we go. No, I'm in the right quarter. I was looking at this up above. See here, these four quarters don't line up with these four quarters, and that's why it's confusing. So yeah, this is the first quarter. Second quarter sale of 600,000 times 70%, or 420, collected in the second quarter, and 600,000 times 30%, 180 collected in the third quarter. Then I have third quarter sales, 800,000. Times 70% collected in the second quarter, and 800,000 times 30% collected in the fourth quarter. Then I have fourth quarter sales. That would be 400,000 collected times 70%, or $280,000. So the total collected in each quarter would be like so. And it pays to add everything across. And down. 1970. Now, the question is, what's ending accounts receivable going to be? Ending accounts receivable should be the fourth quarter sale times 30%, because we collect 70% of that in the fourth quarter, and 30% of this is still going to be accounts receivable, it's still going to be owed by our customers. So it's a good idea to keep that in mind. We're going to need that, because we're going to need to do a budgeted balance sheet later on. So this is going to come in handy then. Learning objective 3 is to prepare a production budget. And a little bit about this is that we want to know how many units am I going to produce, because I need to gear up my factory, buy the materials, buy the labor head, make sure I get the overhead all together so that I'm going to be able to make that number of units. So it's going to be the sales budget. We've already done the sales budget and expected cash collections. The next step is going to be the production budget. And this has to be adequate. We have to make enough units to meet the budgeted sales and provide for the desired ending inventory. So we're going to need to make enough to sell and then have a little bit left over. And we also need to take into account the beginning units in production. So we go over here to production budget template. The assumptions that I'm giving is that the percentage of next quarter's sales in ending finished goods inventory is 20%. Let me explain exactly what that means, because this is very important. We need to know how many, we won't need to make enough units so we have something left over to start next quarter with. We always kind of have a buffer, a little extra inventory. So the way we set that is we take next quarter's sales and we multiply it by 20%. And that's what we want to have in stock at the end of this quarter. Next quarter's sales times 20%. Now, I don't know Q5, but I need to know what ending inventory should be at Q4. So they also tell us that the desired units at the end of Q4 is 3,000 units. So that's also going to be important. And so we have budgeted unit sales back in our sales budget days. That's what we were planning to sell. And then we need some desired units of finished goods inventory. FGI stands for finished goods inventory. So in addition, I need to make 10,000 units, right? But I also need to make enough units just in case for next year, next quarter. So that would be 30,000 times 20%, or 6,000. So I need to make an additional 6,000 units, so I have to cover the sales in the second quarter. And likewise, at the end of the second quarter, I need to have a few extra units left over, 40,000 times 20%, or 8,000. At the end of the third quarter, I want to have 20,000 available times 20%, or 4,000 units available. At the end of Q4, I don't have Q5 here, so the book gives us $3,000. That's what they want to have at the end of Q4. So the total number of units that they need to have available are 16,000 for Q1, 44,000 for Q2, 38,000 for Q2, 44,000 for Q3, and 23,000 for Q4. Now it's pretty cool. For the year, they want to make 100,000 plus have 3,000 available. If you look at this on a yearly basis, have 3,000 available for the beginning of next year. So then the total units needed for the year is going to be only 103,000. It doesn't quite add up here. You'll see how that works out later on. It's an argument that you can make for not doing it this way, but it should be done this way. Now, we have some we also started quarter one with some units. Specifically, I would have started with 10,000 times 20%, or 2,000 units. I would have started, so I don't have to make 16,000 units, because I already have 2,000 units sitting around. So I really only need to make 14,000 units. I really only need to make 14,000 units for Q1. And likewise, Q2, at the beginning of Q2, I would have 6,000. That's what I had at the end of Q1, right? So the beginning of Q2, I would have 6,000. The beginning of Q3, I would have 8,000, because that's what I had at the end of Q2. The beginning of Q4, I had 4,000. And for the year, I would start the year with 2,000 and end it with 3,000. So subtracting this across, 38 minus 6 would give me 32. 44 minus 8 would give me 36. 23 minus 4 is 19. And 103 minus 2 is 101,000 units. So this is how much I need to make in each quarter, and these should in fact add up to $101,000. There you go. See, it adds up. So this would be your production budget, and now you know how much units you need to make. The next thing to do now is to see how much materials, labor, and overhead you're going to need in order to make these units. You begin to get the idea here that we need to plan everything. We need to know how many units am I going to sell. If I'm going to sell as many units, how am I going to make? How many am I going to make? If I'm going to make this many units, then how much materials and labor do I need in order to cover in order to be able to make all these units? And there's a lot of other things that have to happen just right in order to successfully run your company during the period. So these are the assumptions that we're given. There are 15 pounds of sugar in each case, and each pound of sugar costs 20 cents. We need to have 10% of next quarter's production needs in ending inventory, because you want to have enough sugar at the end of a certain amount of sugar at the end of the period in order to make sugar at the beginning of next period. So you want to have a backup. And when customers buy from us, when we make purchases, we pay approximately half of that during the quarter, and we pay the other half during the following quarter. And in the fourth quarter, we want to have 22,500 units of raw materials. So we start off with required production. And our required production here, we determined was 14,000 in the first quarter, 32,000 in the second quarter, 36,000 in the third quarter, and 19,000 in the fourth quarter. For the year is $101,000. That is our plan. This is what we determined that we're going to need in order to run our company. Now, how many units of sugar? This is cases. How many units of sugar are going to be needed? I'm going to call it RM, raw materials, needed per case is 15. So we're going to multiply this by 15 to figure out how much sugar we need in order to meet this production requirement. So we need 14,000 cases times 15 pounds of sugar per case. For for a total of $1,515,000. But we already have some sugar and stuff. Excuse me. We're going to need. We additionally need some. We additionally need some extra units. We said we want to have 10% of next quarter's production needs. So we're going to need some additional units. Add desired raw material units of ending inventory. So that would be 10% of the number of units needed next quarter. 480,000 would be 48,000. 540 times 10%, or 54,000. 285 times 10%, or 28,500. And the fourth quarter, the problem gives us, the book gives us just the number they plan to have, 22,500. So by the end of the year, we want to have 22,500. So that would mean that we need a total of 210 plus 48 in the first quarter, 534 in the second, 568.5 in the third, 307.5 in the fourth, and 1537.5 for the whole year. But we already are going to have some units available. We're already going to have some units available in beginning inventory. So we would have had 10% of our desired production this year. So it'd be this quarter 210 times 10%, or 21,000. This would be 480 times 10%, or 48,000. 568.5 plus times 10%, or 56.85, and 285 times 10% is 28.5. This is the wrong, multiplied by the wrong number. It's going to be 540 times 10%, or 54,000. So then the number of RM units to be purchased would be 258 minus 21, or 237, 46, 514.5, 279, and 1,516,500. And again, it should be noted here that this and this are the same. And it should be noted that my beginning units are 21,000, so this and this are the same, because we're talking about the year now, not month by month. So if this was the year, right, then we have ending units for the year of 22.5, and we have beginning units for the year of 21,000, whereas this goes quarter by quarter. So that's the raw material units to be purchased. And then the next thing to worry about is the cost. So cost of raw material units cost of materials per pound are given to us in the assumptions here, 20 cents. And you got to really think about these to understand it, raw material to be purchased. To understand this, you got to practice it, and you got to really think about what you're doing. And in reality, every company is going to be a little different. And so you want to really understand what you're doing and not memorize it. A lot of students go through this and memorize it. I guess that'll work for a test, but it'll really work if you just understand what you're doing. You do it a few times to get practice and know it, and then it'll just make sense. And then you understand much better how companies work and how to plan. So now, we also want to know, in addition to the cost of the raw materials we purchased, how much money we're going to pay, because we're going to need to do a cash flow budget too. So this is going to help us, obviously, because we need to know what to purchase so that we'll have enough goods to make in order to sell. But we also need to know how much money we're going to need to pay. So my beginning accounts payable, the money I'm going to pay out, I'm going to pay off my accounts payable. I pay bills. When I make purchases, I pay 50% in this quarter, 50% in the second quarter. So that would mean that my accounts payable here, I go back to this balance sheet, my accounts payable is $25,800. I'm going to need to pay that whole thing. I'm going to need to pay the whole thing in the first quarter. And then I'm going to purchase $47,400. So my first quarter purchases would be $47,400, and I'm going to pay half of that now. And I'm going to pay the other half in quarter two. And notice that I link all my cells here, because if one day I want to change this to 45.55 or 40.60. So second quarter purchases were $97,200, but we're only going to pay for half of that in the first quarter. And then we're going to pay for half of it in the second quarter, in the third quarter. Third quarter purchase is $102,900 times 50%. So of that, $51,450 is going to be paid in the third quarter, and the same amount, $51,000. But I'm still using the different formulas here, because if I want to change this later on, I can make all sorts of revisions to my spreadsheet and do all kinds of wonderful what-if analysis. So of this $55,800, half is going to be paid now. The other half is going to become accounts payable. So ending accounts payable would be the other half of this, $55,800 times 50%. Or $27,900, same as that. So I'm going to need that for my ending balance sheet later on. So these would be the monthly cash payments, and total cash payment to purchase raw materials would be $301,200, and that's going to be your direct materials budget. Learning objective 5 is to prepare a direct labor budget. And here what we want to do is we want to see how many workers do we need, and how much are we going to pay them. So we go here to direct labor budget template. And some of the assumptions are direct labor hours required per case are 40.4 hours. And the direct labor cost per hour is $15. So we need the required production in cases. We go back to our production budget for that. There it is. then the direct labor hours per case is given to us as 0.4. It was 0.4 hours. So that would mean the total hours needed in each quarter would be, first quarter would be 14,000 times 0.4 hours, or 5,600, 12,800 in Q2, 14,400 in Q3, 7,600 in Q4, and 40,400 in for the year. Now the DL cost per hour we said is $15. So then the total DL cost would be 5,600 times $15 an hour, or $84,000. $192,000 we have to spend in Q2, $216,000 in Q3, $114,000 in Q4, and $606,000 for the year. And that's all there is to the direct labor budget. The next thing we're going to do is prepare a manufacturing overhead budget. And to do this also, we're going to want to, of course, look at fixed versus variable manufacturing overhead. And we're also going to want to compute our predetermined manufacturing overhead rate for the year. So we go over here to our manufacturing overhead budget template. And the assumptions are that variable overhead per hour is for direct labor hour is $4. Fixed overhead per quarter is $60,600, and depreciation per quarter is going to be $15,000 above and beyond the fixed manufacturing overhead. So the total budgeted direct labor hours, if I know direct labor hours, then I can calculate variable overhead. So budgeted direct labor hours is, I got to go to my direct labor budget, is 5,600 in Q1, 12,800 in Q2, 14,400 in Q3, 7,600 in Q4, and a total of 40,400 for the year. And the variable manufacturing overhead rate per direct labor hour is $4. So every direct labor hour gets taxed with $4 worth of overhead. It's not really a tax, but overhead would move at $4 is considered to be, variable overhead is considered to move with direct labor. So the total variable manufacturing overhead would be 5,600 times $4 an hour, or 22,400. 51,200 for Q2, 57,600 for Q3, 30,400 for Q4, and for the year it'd be 161,000. Now we add, of course, to the variable, we're going to add fixed manufacturing overhead. That is always 60,600. I'm sorry, the fixed overhead includes depreciation. I said that it doesn't, and that was incorrect. So total overhead expense would be $404,000. $83,000 in the first quarter, $111,800 in the second quarter, $118,200 in the third quarter, and $91,000 in the fourth quarter. So that would be total manufacturing overhead. And then less depreciation. So of that, 15,000 is depreciation. I'm not gonna, if I want to figure out the cash paid for overhead, I'm gonna exclude depreciation, because depreciation is something that you don't have to pay for. So even though total overhead will be $404,000 or $83,000 in the first quarter, I don't have to pay $15,000 of that, because it is depreciation. Depreciation you don't pay for. So cash paid for manufacturing overhead, MOH, manufacturing overhead, would be $344,000. We're going to need that for our cash budget. So total manufacturing overhead is said to be $404,000. I'm going to calculate now my predetermined manufacturing overhead rate. Budgeted direct labor hours using for absorption costing purposes, because I need to figure that out for my income statement later on. So budgeted direct labor hours would be 40,400. And therefore, the predetermined manufacturing overhead rate for the year. Remember when I said you have to do this at the beginning of the year based on estimates? Well, this is how you do it, because we're doing the budget now at the beginning of the year. So now is when we would figure out our manufacturing overhead rate for the year. And it's $10. So every hour of direct labor is going to get zapped with $10 worth of overhead using our absorption costing scheme. Now we also have to do number 6, the ending finished goods inventory budget template. That's what FGI stands for, finished goods inventory. And we need to know how much inventory we're going to have for our balance sheet. And we also need to know what our unit product cost is. So when it comes to production, we have 3 components. We have direct materials, we have direct labor, and we have manufacturing overhead. And by direct materials, what it goes into one unit. By direct materials, I'm going to go back to my assumptions page here. 15 pounds of sugar go into 1 unit. £15 go into a case, and that costs $0.20 a pound. So the total cost would be 15 times 20 cents, or $3. By direct labor, we said that 0.4 hours of direct labor, and you get a bonus if you can tell me how many minutes that is. Good, it's 24 minutes, right? 60 times 0.4 would be 24 minutes. It takes 24 minutes to make a case. Although, and each hour costs $15. So that would mean labor that goes into 1 unit would be $6. Overhead, the predetermined overhead rate, is going to be the same as direct labor. So it's going to be 24 minutes, 0.4 hours. The cost, though, is going to be the predetermined overhead rate, which we just calculated to be $10 per hour. And therefore, overhead will be assigned. And this is, since it's a predetermined overhead rate and it's absorption costing, it includes the fixed cost. So the total would be 3 plus 6 plus 4, or $13 per unit would be your absorption cost. And again, remember that's absorption cost, so it's incorporating fixed costs in there. Now then we have budgeted finished goods inventory. So my ending finished goods inventory in cases is going to be over here in my production budget. 3,000 units, remember? And the unit product cost is going to be $13 a unit. So my ending inventory, which is going to go on my balance sheet, will be $39,000. At least ending finished goods inventory. Will be $39,000. Coding objective 7 is to prepare a selling and administrative expense budget. And so to do this, we're going to get our Excel and go to 7. I tried to number these. The book doesn't really number them, but I found that it's also on my sheet over here. I numbered them 1 through 10 because you would do them in this order. You could also almost think of these as being like steps, you know? So here we go. Here's the Excel spreadsheet. S&A budget template. And there should be a link to this with the YouTube video and also in Blackboard. Variable selling and administrative expense per case is $1.80. And then we have these fixed expenses also to take into account. Those fixed expenses are per quarter. So budgeted unit sales is over here in my sales budget again. You probably wonder how anybody did this before Microsoft Excel. The really great thing about Excel, it doesn't show you this in the problem because I think there's enough work in this chapter already, but it was mentioned earlier. If you use Excel properly and you link up all your cells instead of putting in hard values, then you can change this around, because what's going to happen is that it's going to be an iterative process. You'll see this in the income statement or the cash flow, the cash budget. When you do your cash budget, you'll see that you run out of cash, or the profit is too low, or the balance sheet, there's too much debt, and then you have to go back and change things. Someone comes in, they say, this assumption was wrong, can you fix it? And all you have to do is change things in the spreadsheet, and then all the numbers will flow down and change with them. So Microsoft Excel is exceptionally well suited to this. There are some problems with doing this in Excel, and there is a movement to use budgeting software instead of using Excel. But for purposes of learning how to do this, Excel is really great. So this is $1.80. And so total variable S&A expense and then we'll have fixed S&A per quarter. We have all these things right here, and I'm always one for saving time. So this would be variable. This would be rather total fixed S&A expense. So total S&A expense would be the 99,000 would be equal to variable S&A plus fixed. Should really be a line in there. And then what we would do is we would subtract depreciation. So this is total S&A expense that'll go on our income statement. Now we're going to subtract depreciation again, back off of it, because depreciation is a non-cash expense and the other ones are cash expenses. To get cash payments for selling and administrative, cash payments would be $117 minus $10,000 or $107,000 because we're going to need cash payments for the cash budget. What we're really doing here, to a large extent, is we're preparing for what's to come, and we're preparing for putting the information together that we're going to need, and it all kind of flows towards the cash budget, the income statement, and the balance sheet. But these are your cash payments for selling and administrative. So learning objective 8 is to prepare a cash budget. And this cash budget will be divided into 4 sections. The first will be cash receipts, all the money coming in, mainly sales. Cash disbursements would be money going out. And remember, this is going to be cash, so it won't be sales, or it'll be cash received. Cash disbursements will be cash paid. And then you'll come up with what's called an excess or deficiency. And the excess or deficiency will determine if you need to borrow money. If it's too negative, if your cash balance is going to be too low, then you're going to need to borrow money. And if you have an excess, then you might be able to use that excess for something, or you might want to just leave it in the bank. But that's up to you. The important thing is to go through this process so you know how much cash you have and you're not taken by surprise later on. The financing section is going to list how you borrow money or pay back money, things like that. There are a few important rules here. We have a minimum cash balance of $30,000. We plan to purchase some equipment, so that's going to require some cash payments. There are dividends of $8,000, simple interest per quarter of 3%, and that's 3% per quarter. It's very strange. That's how the book put it. Note that that's per quarter, not per year. I would never write an interest rate that's not annual, but for some reason they did that. And loans are in $10,000 increments, meaning that you can't borrow $25,000. You can borrow $20,000, you can borrow $30,000, you can't borrow $25,000. So we start with beginning cash balance. And that is, you got to really know what you did, and you got to remember it. You got to remember where everything is. That's on your beginning balance sheet right here, $42,500. That's what we're going to start with. And then we're going to add our cash receipts. And I have one cash receipt only, collections from customers. And that will be in my sales budget. Right here. And I can fill it all in. Now my beginning cash balance for the beginning of Q2 is going to be the ending balance at the end of Q1. So I'm going to need to roll that forward. So there are some things I can fill in now, and there are some things I'm going to have to go back and fill in after I finish quarter 1. So total cash available would be $42,500 plus $230, $272,500. And then we have cash disbursements. And the first one is for direct materials, because I'm going to have to buy direct materials. So for that, you go to your direct materials budget. And you have to be very careful to get the cash payments or disbursements, not the actual cost of direct materials purchased. Direct labor is pretty easy. They're the same. At least in our case, they are. So direct labor budget is here. Then I have manufacturing overhead. That would be, again, I want manufacturing overhead that's paid for right there. And then selling and administrative. This would be the amount of selling administrative expense paid. So remember, I subtracted depreciation to arrive at cash payments for selling and administrative. There it is. Then I have equipment purchases. For that, I got to go up here. You might be better off just doing first quarter, second quarter, but to save time, I find, it all comes from the same place, so you might as fill in the whole row. And then I have dividends of $8,000 per quarter. A total of $32,000. So total cash disbursements would be $366,500 in quarter one, $552,100 in quarter two. Notice that I don't have cash available yet, but I have cash disbursements all figured out. So now comes the key number, excess deficiency. And that would be cash available minus cash disbursements would be, it's a deficiency of $94,000. I'm not writing the totals in for the other because they're not the next few rows because they're not going to be correct. So I'm going to let them be. So for financing purposes, I'm going to need borrowing. It's pretty cool how we do this. Borrowings at beginning. And then I'm also going to have prepayments, which would be end of the year. I would make a repayment. And then interest also would be paid at the end of the year. And this is just how this particular company runs. Every company is going to be a little different. So the total financing cost here would be the total of these numbers. And then my ending cash balance would be the excess minus the financing, or I should say plus the financing. And it would be a $94,000 deficiency. So what I would need in order to rectify this is I would need to borrow, because I want to have a minimum of $30,000, right? So I would need my balance, the minimum balance is $30,000. And the deficiency is 94. In fact, I'm going to type this out because it's kind of a dangerous, otherwise I'm going to get a circular reference. So the total needed is really 30,000 plus 94, $124,000. There's just one problem with that, and that's that you can't borrow $124,000, so I have to do it in $10,000 increments. So the real amount to borrow here is going to be $130,000. So back here, I'm going to put in my borrowings $130,000. It's a positive number because the money's coming in, but now I'm going to owe it. And that would leave me with $36,000, a little more than I wanted at the end of the year, at the end of the quarter. So the beginning of the next quarter, I'm going to have $36,000. This is kind of like a backward maneuver you got to do to get to this number. And in Excel, you got to be very careful. I could back this number out and add $6,000 to it, but then I would get a circular reference. So I kind of do the calculation on the side, maybe even delete it later. So I ended the first quarter with $36,000, meaning I begin the next quarter with $36,000, and that would give me $516,000 available. And I have a deficiency again. So I got to figure out what would I need to get past this deficiency. Again, my deficiency is $36,000. Desired balance is $30,000. So amount to borrow would actually be $66,000. Again, that doesn't round to the nearest 10,000. Actual borrowing would need to be $70,000. So the repayment here, the borrowing rather, would be $70,000. And let's see if that gets us where we want to go. That would mean financing is $70,000. Now my ending cash balance is above $33,900. And by the way, the reason why you want to have a buffer zone there, one reason is because there could be a mistake in your budget, you know? So if there's a mistake in your budget and you were planning to have just exactly $1 and there's some kind of mistake, then you would run out of cash, and that would be a huge crisis. You never want to run out of cash. So beginning cash balance is $33,900 plus $740 would be $773. The excess would be $165,650. Good. So therefore, there's nothing to do here. There's no money to borrow, no nothing. And then I end up with $165,650. So now I'm going to start the fourth quarter with $165,650. And I'll fill in the year in a moment. Technically, there should be a line underneath this because it's a subtotal, and then I start a new subtotal underneath. $685,650 and minus cash disbursements of $422,350 is $263,300. But I'm going to need to pay back this other debt. So I'm going to need to pay back $130,000 and $70,000 or $200,000. I'm now going to need to pay back. In addition, I'm going to need to pay interest. So principal times rate times time. The first loan was for $130,000. The rate is, this is where things get confusing, 3% divided by 3, or 1%, because 3% is per quarter. The quarter is 3 months, so it's 1% per month. And this was outstanding for 12 months, because it's 4 quarters it was outstanding, and it said it was borrowed at the beginning of the first month. So total interest on this loan would be $15,600. On the second loan, it would be $70,000. Again, the rate is 1%. The period of time here would be 9 months. Because we took out the loan at the beginning of the second quarter, so second, third, fourth quarter is 9 months. So that would be 9 months. And it would be 70,000 times 1% times 1% per month times 9 months would give you a total of $21,900 in interest. So that would be money coming out at $221,900, $263,300 plus a negative 221,900 would give you 41,400, and that's still more than our $300. Now let's do the year column. The beginning cash balance for the year would be 42,500, and then total cash available would be 42,500 plus 1970, and these are not going to add across. They will not add across. Here, $63,300. And now for financing, I borrowed $200,000. I had repayments of $200,000. And I also paid interest of $21,900. Always use good Excel format. So total financing costs were $21,900, and that would give me an ending balance of $63,300 minus $21,900 or $41,400. And that's what your cash budget would look like. Learning objective 9 is to prepare a budgeted income statement. So we go off here to budgeted income statement template. And again, we're going to need to move around a little bit between different budgets. You'll see where I'm getting everything from, but in the book it also explains this in more detail. Sales is obviously going to come from the sales budget. We have to go way, way back there. It's $2 million. Cost of goods sold. We got to do a little bit of, we're going to have to do a little math to do this. I'm going to work down here. We got the number of units. The number of units to be sold is here in my sales budget. $100,000 units, and the cost per unit was in my ending inventory budget over here, $13. So the total cost per unit and I'm just improvising based on the information that I have. $1,300,000. That would give me then gross margin or gross profit of $2 million minus $1,300,000 or $700,000. Then I've got selling and administrative expenses, and because we set everything up very carefully before, all these numbers are ready and handy for us so we can do these calculations. You got to be careful to get the expense, not the cash paid. Expense is in this line, cash paid is in this line. So that'd be $576. And net operating income would then be $700,000 minus $576 or $124,000. Then I have interest expense. That was in my cash budget, right over here. And I wrote that as a negative, but I think I want to express that as a positive and then subtract it. It could be done either way. So we get net income of $102,100. Did you say bless you? You just blessed the video. I'll be playing this video for years, and people are going to be saying bless you. And when you think about it, right, a bless you means you're giving me a blessing for sneezing.
And I'm like, a year from now, 2 years from now, someone could be watching this video. I sneeze and go, "Oh, bless you," just impulsively, and I just got a blessing. So anyway, that's budgeted income statement. And learning objective 10, prepare a budgeted balance sheet. This is the last piece of it. Now, this is an iterative process because when you do this budgeted income statement, you're looking at it and you're saying, is that the income I want? Or you might do it and you get a loss. And by the way, when you go through with GoVenture, right, and you do a what if analysis and you get a loss, that means you should go back and change everything around to see how you can get a profit. So here you would look at this and you would say, maybe I need to change some things around. And then maybe you would go back to your assumptions back here and you'd say, you know what, this sales estimate's a little conservative. What if it was $15,000? And then all the other numbers back here would change. So I could go back here to my income statement and you could see my income now is higher. Because that's the wonderful thing about Excel is you could change all these things around. Sales would go up, cost of goods sold would go up, some of the expenses would go up. It's all been programmed into Excel, and now you could change things around and see what would happen. I just put it back the way it was. And the way this would happen in the real world is that process is going to take several months. And people are going to go back and change it, and there's going to be negotiation, and do you think you can cut your fixed cost a little, and so on and so forth. So let's go to the budgeted balance sheet now. And again, this is going to take information from a lot of other places. In order to arrive at a final balance sheet. So my assets, and if you want, what you can do is you can use the previous balance sheet as your model. Honestly, that's what I'm doing here because balance sheet should be the same anyway from one year to the next. So cash, where am I going to get cash from? And you got to really remember what all the numbers are here. This is a huge thing. Students say, well, are you going to ask this on the test? I can't ask you to do a whole budget like this on a test, but pieces of it, you'll see some old tests where we ask for specific budgets to see if you can prepare, a cash budget or something. But to do the whole thing is really in an hour without Excel or something is really asking a lot. Accounts receivable would be on the sales budget. If you remember way back when, we put it right there, ending accounts receivable, $120,000. And you're probably like, why does he have to do it now? Because it helps you later on. So raw materials inventory is going to be in my direct materials budget. Here we go, direct materials budget. I have desired raw materials units of ending inventory, $22,500 right there. And I have finished goods inventory. That was in my finished goods inventory budget. Right, ending finished goods inventory budget, $39,000. So you got to think about these things as you're preparing your budget to make sure that you're going to have everything you need. Or you might go back to it. Just looking at this is a mistake. This is just 22,500 was the number of units. So that's not quite what we're looking for. We're looking for the dollar value. So I'm going to go back here to my direct materials budget template. And number of units of ending inventory at Q4 was 22,500. And the cost of raw materials per pound is 0.2. So value of ending inventory would be 22.5 times 0.2 or $4,500. So now we go back here. This is E39. There you go. $204,900. And then I have long-lived assets. Land is easy. Land is the same as it was last year. We didn't buy any land. So we go way, way back to our beginning balance sheet where we had lands of $80,000. Now, we got to do some calculations here for buildings and equipment, because if you remember, we purchased some buildings equipment and we recorded depreciation. So I'm going to do something called a roll forward. The beginning balance of buildings and equipment, I go back to my old balance sheet for this, is $700,000. And accumulated depreciation was cell D14, $292,000 on my previous balance sheet. And what I'm going to do is I'm going to roll forward the balance and record everything that affected these balances. So I acquired new building, new equipment. If you remember from my cash budget, right over here, $130,000. So that's going to increase my building and equipment. I also recorded some depreciation with manufacturing overhead. So that was in my manufacturing overhead budget. Right over here, I recorded $60,000 in depreciation. And then I recorded more depreciation with selling and administrative expense. There it is, $40,000. So my ending accumulated depreciation should be $392,000, and my ending building equipment should be $830,000. If I had gotten rid of equipment, then I would need to subtract from buildings and equipment, and I would need to deduct some accumulated depreciation on the equipment that I got rid of. So $392,000. So the total plant and equipment would be $518,000. And this is the point where it gets kind of scary. You got to add it all up to get total assets. And of course, assets must equal liabilities and stockholders' equity. And you got to be very careful to get everything right. When I go through this, I check and double check everything as I do it, because, and not just against the answers. Like I try to find, ways to double check my work as I go along, because it's very hard to find mistakes later. Accounts payable was in the direct materials budget. There it is, $27,900. And then I paid off all those debts, so I don't have to worry about them. I've got stockholders' equity. Common stock was, go back to my old balance sheet, $175,000. And retained earnings, I'm going to need to also do a roll forward. So if you remember from Accounting 2103, it's beginning balance plus net income minus dividends equals ending balance. So the beginning balance of retained earnings from last year's balance sheet is $449,000, and then my net income, that comes off my income statement. What's the chance? Come on, what's the chance that this balance sheet is going to balance? $102,100. And then dividends would be, dividends were also in cash. There it is, $32,000. So the ending balance of retained earnings is $520,000. So total stockholders' equity would be equal to $695,000, and liabilities plus stockholders' equity would equal $722,900. There you go. That's the whole balance sheet right there. It's a big exercise. And again, what's going to happen when you go through this is that you're constantly going to go back and change things to try to improve cash flow, try to improve profitability, and you discover here's where you can really discover changes that you can make that can help the company to run more effectively. So that is budgeting, chapter 9.